Welcome to another case study by Blueprint to Escape.
Glad to be here for this one.
Yeah, so today we are looking at a mid-March 2026 investment portfolio. And right now, it is generating an approximate 15% yield.
Right, which is a notable figure to unpack.
It is. So the mission for today's session is to really methodically review the adjustments made to this portfolio during March. We'll look at the specific asset allocations, the split between Canadian and U.S. holdings, and then go over the reasoning behind targeting business development companies, or BDCs, for the April plan.
Yeah, but before we get into the actual data, we do need to clearly state the disclaimer provided in the case study.
Oh, right, of course.
So everything we are discussing today is strictly for educational purposes. It does not constitute financial, tax, or legal advice.
Yeah, you definitely must do your own research or, consult a professional.
Exactly, because everyone's individual goals and starting points vary.
Right. So with that established, let's just move directly into the March portfolio actions. And to really understand the current structure, we have to look at the reductions they made amidst all that market turbulence.
Yeah, they didn't just buy the dip blindly, they actually consolidated.
Right. The data notes a reduction in total holdings from 29 down to 25.
Which is instructive. The case study explicitly warns against this concept of worsification.
Diversification.
Yeah, the risk of over-diversification. I mean, we are generally taught that diversification is always good.
Sure, spread the risk.
But mathematically, there is a limit. The case study identifies the sweet spot for an income portfolio as, 20 to 25 holdings. If you hold more than that, you end up with overlapping exposure.
Okay. So you're managing risk, but without diluting the impact of your really strong assets.
Precisely. And we see that in the specific Canadian sales they made. They sold out of ECI, GNY, and UTs.
Right. And the rationale noted was to eliminate overlap in Canadian banks, gold, utilities, and energy, while also locking in some capital growth from UTs.
Right. It kind of reminds me of pruning a garden.
How so?
Well, if you just keep adding plants, they eventually choke each other out. But by removing the overlapping or redundant plants, your core crops get more water and soil to just grow steadily.
That's a really clear analogy for portfolio hygiene. And we see that exact hygiene on the U.S. side of the ledger, too.
Yeah, with WGMI, they sold it at a 2% loss.
Right. They took a small paper loss to reallocate those funds directly into Google. Or GOGL. It's just routine hygiene.
Okay, but looking at the pruning, there is one mathematical anomaly in the data that stands out.
The HDIV weighting.
Yes, exactly.
Yeah.
So the case study has this strict rule to keep individual holdings under 15% of the total portfolio.
Right, to prevent any single asset from sinking the ship.
But HDIV is sitting at 17.4%. So, did they break their own rule there?
Well, no. They didn't actively buy more HDIV to push it over 15. It's just a byproduct of the math during that month's geopolitical volatility.
Meaning the other assets dropped in price. Exactly. The other assets declined, but HDIV maintained its value. So mathematically, its percentage weight in the portfolio naturally increased.
Ah, I see. The rest of the pie shrank, so that specific slice just looks bigger.
Exactly.
Okay, so with the portfolio successfully pruned to 25 holdings, let's look at the specific allocation data, especially regarding that 15% target yield.
The geographic and account structure here is really foundational.
Yeah, it notes 78% of the holdings are in Canadian dollars, housed in TFSA and cash accounts. And that's specifically for income purposes.
Right, because the TFSA shields that income from taxes, which is crucial if you're living off it.
And then the remaining 22% is in U.S. dollars, kept in RRSP accounts.
Yeah, taking advantage of the tax treaties. The RRSP avoids the standard 15% U.S. withholding tax on dividends, so it's efficient for both income and long-term growth.
Right, which explains why a 0% yield asset like Google is in there. But regarding the yields on some of these other assets, the case study tables list some really high numbers. Like there's a USD holding ET at a normal 7%, but then on the CAD side, HHIS is at 29%, HBTE is at 27%.
Those are substantial numbers.
And there's one, BTCI, sitting at 43%.
Right.
I have to ask, how does an investor differentiate between a sustainable high yield and just a yield trap? A trap that just slowly erodes your principal investment.
That is the critical question. And the case study addresses this directly through the concept of net asset value, or NAV, erosion.
Okay, so how does that work in practice?
Well, yield trap essentially pays you back with your own money. So your capital base just shrinks over time. But this strategy emphasizes total return.
Meaning the yield plus the actual underlying price of the asset.
Exactly. You have to balance the steady income distribution with mild capital growth. You can't just blindly chase the highest yield percentage.
Right, because if the asset price goes to zero, the yield doesn't matter.
Precisely. And it's also worth noting, the case study actually prefers a 12 to 13% yield environment.
Oh, really? But they're at 15%.
Yeah, so that 15% yield often just indicates that broader market prices are currently suppressed.
Oh, because the payout amount stayed the same, but the asset price dropped?
Exactly. So the percentage naturally goes up,
Ah,
but it's not from taking on more risk. It's just market mechanics.
okay, that makes sense. So having analyzed the current setup, let's transition to their forward-looking plan for April.
The focus on BDCs.
Yes, the primary action is to look at topping up positions in PBDC and INCM. These are exchange-traded funds heavily focused on business development companies.
Right.
So how does the case study define a BDC for those who might not know?
Well, they are specialty finance firms. Basically, they lend to small and mid-sized U.S. companies.
Okay, so kind of like a specialized bank for the middle market.
Yeah, essentially. And they offer high dividend yields because structurally they're required to pay out most of their taxable income to shareholders.
Ah, so the high yield is baked into the regulatory rules.
Right. But the trade-off is they carry a much higher sensitivity to economic credit conditions.
Right, if there's a recession, those mid-sized companies might struggle to pay back the loans.
Exactly.
So it kind of sounds like buying real estate in a really solid neighborhood, but during a temporary market dip. Like the underlying value is intact, but the entry price is discounted due to broader market sentiment.
That's a good way to look at it. The case study breaks down the why now data into two main factors. First is that valuation reset you just mentioned.
Right, the discount.
Yeah, these ETFs are currently trading at lower prices relative to their actual net asset value, which improves the effective yield for new buyers.
Okay, and the second factor?
The historical recovery potential. Historically, BDCs tend to overshoot to the downside during these fear-driven sell-offs.
Oh, so the market panics more than it mathematically should.
Exactly.
Right.
Which creates a calculated risk-reward window for incremental additions.
Incremental being the key word there, I assume.
Very much so. The case study reminds you that these are satellite holdings. They are not the core anchors of the portfolio.
Right, so you don't bet the whole farm on them.
Definitely not.
So looking at all these tactical moves, the pruning in March and the BDC plan for April, it seems driven by a much broader philosophy regarding wealth.
It is. The case study outlines a strategy of building sustainable passive income with a primary focus on capital preservation.
Right, avoiding market timing, simply reinvesting the income.
Yeah, and investing with deep conviction in understood sectors. Things like Canadian banks, technology, healthcare.
There's actually a specific mention of Jim Rohn in the data about setting the sail and building a boat to weather changing market winds.
I like that analogy.
Yeah.
Because it applies so directly to you, the listener. You have to match your portfolio to your age and your distance from retirement.
Right. The portfolio in the case study is structured for a nomadic expat with a Canadian home base, which obviously influences that CAD to USD currency split we talked about.
Exactly. The strategy insists that as your capital becomes secure, you transition from growth assets to these stable, covered call ETFs.
Okay, but the case study also emphasizes maintaining a stoic, calm attitude, doing less during turbulent times.
Which is easier said than done.
Exactly. I mean, how does an investor actually implement that stoic discipline when the data on their screen shows their portfolio value dropping in real time?
Well, the case study connects that psychological discipline directly back to the structural data.
How so?
When your core anchors like HDIV, EBNK, or QQQI are methodically selected, and you respect those allocation limits, you essentially engineer the Stoicism into the system.
Ah, so the investor doesn't have to be perfectly unemotional because the portfolio limits do the work for them.
Right. You don't need to react to daily news because the structure itself provides the emotional buffer.
That makes a lot of sense. Just rely on the mechanics.
Exactly.
Well, this brings us to the end of today's review. For those listening, please post comments or questions below. We'd specifically ask you to share your own favorite income strategy.
Yeah, it's always interesting to hear how others approach yield.
Definitely. And remind you to subscribe for more content about financial independence, passive income, early retirement, and nomadic life design.
And just a note, the full portfolio case study is updated mid-month, around the 20th, to align with distribution schedules.
Good point. So to wrap up, we want to leave you with a question to consider. If a portfolio is mechanically designed to weather economic turbulence without requiring your daily intervention.
Which is the whole goal of this structure.
Right. how does that level of passive reliability fundamentally alter how you value your daily time and choose your physical location in the world?